Okay, let's get started. Thank you very much for attending and spending your time with us. We should be here I'm going to try to keep it within 30 minutes. With that being said, I'm going to be talking pretty quickly. I apologize. So let's go ahead and dive into here. All good webinars start with a disclaimer, right? So this material is just for educational purposes and informational purposes only. We're not intended to provide or should not be relied on any investment, tax, legal, or accounting advice. Bottom line, you don't know us. We don't know you. The idea here is to share with you what we do, see if there's a fit based on what you're looking for, and then we can communicate on another individual basis to see if there's a fit between the two parties. So let's go ahead and dive in here. Who am I? There's my picture. I apologize as best I can do. If it's not good enough, blame my parents and God. So my name is Robert Wolf, and I've been helping individuals and small business owners since 2001. I'm a member of these various associations. I've created to help, really created this to help business owners and medical professionals, physicians, dentists, chiropractors, etc. And we'll dive into this process more, and you'll understand what I mean by why I created this. I'm a husband and a father. This is the most important part of my life right here, is being a husband and a father. The rest is really secondary, but I will tell you, I will give you 100% outside of my family. So our goal really is to help you reach your needs and your wants by increasing your cash flow. We increase your cash flow in the following ways: appreciable deduction planning, which we're going to talk about today; money efficient planning, which I'll show you an example towards the end. If you want to see an example of what this means, it's at the very end. And then exemption planning, we're not going to talk about today. It'll be another conversation. Our approach is through education. Give you a couple examples of what I mean by that. I don't know if you've read any of Malcolm Gladwell's books, but he wrote a book called Outliers, and it's a very good book in the sense that he talks about the 10,000 hour rule. He uses an example of Stephen Jobs and some various other well-known people in their industries and how they became outliers in their business. And it's all really based on the 10,000 rule. Basically, 8 hours per day, that would be 1,250 days, so that would equal 5 years of 100% of time to get the 10,000 hour rule. So I bring this up because I've spent the last 18 years studying what I'm going to present to you, working on what I'm going to present to you, presenting to business owners, asking, researching, whether they're in companies that are within the insurance or finance world or real estate or banks, or whether they're professionals in those industries, books, articles. You get the point. So I've accumulated well over the 10,000 hours to provide you this information. So really, how did this all come about? In the very beginning, before I even decided to enter this business, I read a book by Robert Kiyosaki called Rich Dad, Poor Dad, which I felt was a very good book. And then after we read a good book and a good author, we do what? We buy another book that they wrote. And so I bought Cash Flow Quadrant. And this is really what caused me to get into this business, to want to help business owners with their life. So he talks about the cash flow quadrant and breaks it down into 4 sections, 4 quadrants. The first one being an employee. You have a job, you trade time for dollars. The second one is self-employed. You own a job, you're still trading time for dollars. Now, we're going to take this from a shift perspective and saying that we're not really concerned about wealth. The 5% of the U.S. wealth is really based on these 2 quadrants. But really, from a taxation perspective, these are the 2 highest taxpayers in this quadrant. And so that's where we'll talk about today and how we can solve that issue, or at least get closer to solving that issue. You can be a business owner and you own a system, so you have people that help make a widget or provide a service that may be the widget. 95% of the wealth is developed here. And the reason being is because as a business owner, you have a lot of tax benefits, and you hire employees or taxpayers, and we'll talk about that some in this webinar as well as in our one-on-one conversations. The goal and the idea is these 3 quadrants are really trying to be investors, where you own investments, where you have investments that are assets that are compounding and should be appreciating, to where Robert Kiyosaki talks about this in some later books, and some of his other advisors talk about this as well, is that where you have different streams of income, different streams of assets compounding compounding, you create what's called the velocity of money. And the velocity of money all of a sudden is like a freight train going downhill. It becomes very difficult to stop. And the goal is to allow this velocity of money to out-earn what you are earning as an individual. So basically, you're using your assets to duplicate what you're trying to accomplish on an individual basis. So then I read a book by Richest Man in Babylon, and there's 7 rules that are laid out in this book. And this book's about 100 pages long. It was written in 1926. So these rules you've heard about before. Okay, so let's dive into them. Rule 1, start thy purse to fatten. Basically, pay yourself first. You've heard that before. Pay yourself first. Control thy expenditures. Control your expenses. Rule number 3, make thy gold multiply. Let's earn a fair rate of return. Rule 4, guard thy treasures from loss. Don't lose money. Now, let me make this very clear right here. Everybody that I talk to, when I say don't lose money, they're thinking about the stock market. My friends, that's not even close to what we're talking about here. We're giving away money in all different areas of our life. Our goal and our focus and our money efficient planning is to eliminate that as best as we can. Make thy dwelling a profitable investment. Own real estate, and we'll talk about this more in detail in other conversations. Ensure a future income. Let's protect your family. Increase thy ability to earn. Increase your ability to earn. So that's what we talk about where we're talking about multiple streams of compounding interest, multiple streams of income. That velocity of money is right there. And then we added an 8th rule. This rule you will not find in the book. Pay thy fair share in taxes. Let's work on reducing our tax liability. Okay, so let me make this very clear here. The IRS is not our adversary. Okay, we view the IRS as daddy. Okay, you try to put your finger in the socket, you're going to get shocked. Okay, so there's certain rules and guidelines that are laid out by mom and dad in the household. The IRS does the same thing. It's called the IRS code, right? It's the tax code, and they're laid out. It's a map. All right, and if you're trying to get from point A to point B, you need the GPS system. You need a SERPA. You need a guide to show you how to get from point A to point B. Okay, and we're going to talk about that here. So please understand, when we're talking about reduced tax liability, we're not talking about lie, cheat, hide, or try to screw over the IRS. Absolutely not. We respect daddy, and the IRS gives us code. Let's just use those. Let's use those guidelines because there's plenty of opportunity with what he has given us. Okay, so when it comes to planning, there's 3 types of planning. There's family planning, normal financial planning. There's business planning, where you have someone who may set up a 401k plan or some kind of retirement plan at the business, insurances, health insurance, that sort of stuff. And then both of those, family planning and business planning, equal to legacy or succession planning. You've worked hard your whole life to build up whatever assets you have. How are those going to pass on, whether too early or exactly when you want them to at death? The bottom line is that there's no separation from these 3. Unfortunately, I have found that working with business owners, a lot of these business owners have different professionals in all these areas, and none of these professionals talk. There's no continuity between the plans, and so that's what we essentially do, is we bring continuity. But no matter how good your plan is, you could be affected by what we call economic termites. So what's an economic termite? Well, before we dive into that, what's a termite? Exactly, it's the little bugs that eat away at the foundation or eat away your porch or your basement, right? When do you know you have a termite problem? Exactly, when the damage has been done. It's too late. So economically, we have termites as well, where if we find them too late, the damage will have been done. So our goal is to show you what economic termites are out there and how to prepare for them. So what are those economic termites? Well, the first one's taxes. This is the first one we look at and we try to attack, because every tax dollar saved and not paid out to the IRS or to the state is basically a guaranteed rate of return, right? It's not going out the door, we're recouping it, so we're keeping it. And so this is kind of what we're focusing on, is if we can keep some of these dollars, we can use these dollars to plan for these other termites, such as inflation, time, and laws and regulations. These are the 4 major economic termites that we build plans for. The other economic termites are interest rates. Well, it depends on what side of the interest rate you're on, if it's good or bad. Procrastination, we're all guilty of this. Running out of money, being concerned about that. Stress and sleepless nights, watching your money dwindle. We use the term portfolio because it's a common term. We're not talking about just your stock portfolio, your real estate portfolio. We're talking about your assets. We don't use the term asset dwindle down because based on how we perform and create these, if an asset is dwindling down, then it's no longer an asset, it's a liability. So an asset is supposed to create income, it's supposed to create appreciation. So that's why we use the term portfolio. Just want to make sure that's very clear. Market volatility, this is, yes, stock market, but also all markets that we invest our money into. And then serious health events. Now, one of the things we talk about is that there is no perfect product, there is no perfect service, there is a perfect plan. And so what we do is we look at all the things that are laid out on the Thanksgiving table. Everything is laid out there, all the food groups, right? And you decide on which ones you're going to eat, okay? And some are going to make you fatter and sicker than others. But we want to make sure that that it's all out there. So we're going to lay it all out there. We're going to look at it all when we work with our clients. As a thank you gift for attending this webinar, we're going to give you a free white paper, Economic Termites. It just talks about the history of taxes, inflation, time, and laws and regulations. The fun part is Chapter 4, talking about some of these laws and regulations that affect us. That's kind of interesting. Okay, so let's dive in here. So how did appreciable deduction planning process come about? Well, working with business owners, I realized that there is 2 separate, we were always viewed as 2 separate people, right? You and your business. But in reality, there's no separation, is there? If you decide that you want to go on vacation, it's going to affect your business. You got to plan accordingly and vice versa, right? If there's an economic downturn and the business is not doing as well, it affects you individually. So there is no separation. So we understand that. So what we try to do is our planning process is to take that in consideration. So if you look at this picture here, this is an oak tree. We know oak as a wood is a solid, strong wood. It's very expansive as a tree and provides a lot of shade and ground, right? Well, when we were looking up at the tree when we were with Grandpa, we'd ask Grandpa how old this tree was because it's so big. And Grandpa would say, well, you cut the trunk of the tree and you look at these rings, and each of these rings represented what? Exactly, the age of the tree, right? We all know the answer to that. So we take this as kind of our planning process. So if you can indulge me for a second, you are the sapling. Okay, you're the very middle. And then when you started your business, you created some kind of layer of protection by setting yourselves up as an LLC, partnership, S Corp, C Corp, whatever the case may be. Okay, if you're set up as a sole proprietor and filing a Schedule C in your tax return, we do have to have a conversation depending on your business model and what you're doing and trying to accomplish. But then when you started your business, you had to have insurance to protect your business, that it protects you. And as you see, each of these layers protect you as the sapling. And then when we come in, we add a strategy, and that strategy is to complement the previous rings, and every strategy we implement and complements the previous strategy, and as well adds a layer of insulation to protect you, the sapling. Okay, so hopefully that's clear. So we decided, how do we do this? Well, we had to focus on a formula. So we created a formula. It takes your adjusted gross income, also known as AGI. That's basically on your 1040 tax return, your personal federal tax return. Down on the bottom is your adjusted gross income. Then we look at your what we call your lifestyle income, living expenses. Sometimes you'll hear us called lifestyle expenses. Basically, what do you spend your money on? We don't need details. You know, you can spend $2,000 a month in Vegas or on movies or sports. We don't care. It's your money. It's your lifestyle. We just need to know what that dollar amount is. And then when we subtract that from your adjusted gross income, that equals what we call non-lifestyle income. That's discretionary income. It's extra money. We don't like the term discretionary because that means that it's extra. You could go spend it elsewhere. No. We want to make it work for you, right? You work hard for your dollars. So if you have extra dollars that aren't part of your lifestyle, we want them working hard for you, right? We want to create that velocity of money, okay? So what we're saying here is every dollar in non-lifestyle income is being taxed at your tax bracket. So what it means is you are paying taxes on income not needed for your lifestyle. So technically, you're just giving money away to the IRS. This is not a very good plan. Okay, so what we're going to do is we're going to show you how to take that non-lifestyle income, shift it from your personal tax return back to your corporate return. Well, how do we do that? Well, let's look at this example here. This is an income funnel. Okay, and up top we have all our income, and our income we generate goes down the income funnel and summarizes on your personal tax return. Well, where does it summarize on your personal tax return? Well, the first page, lines 7 through 22. Now, this is going to be updated because of the Tax Reform Act of 2018. Well, it's 2017, but it's effective in 2018. But here's where all your income lies. Okay, so if you have wages, line 7 is your wages, W-2 income. If you're a sole proprietor, what I was saying earlier, your Schedule C is line 12. Any partnership, real estate royalties, that sort of stuff, Schedule E, which is your S corporation, your K1, that kind of stuff, is line 17. And down on the bottom is your total income. Okay, so what happens is that with our formula, if you have your adjusted gross income, AGI, minus your lifestyle income, your non-lifestyle income is not needed. So we shift it from your personal tax return back up the income funnel as a deduction. Okay, so let's talk about deductions here, because going through this process we found out not all deductions are created equally. So we have revenue and we have expenses. So let's make sure this is very clear. Okay, the revenue, the IRS has given us this huge gift. The IRS has said you're earning revenue as a business and you have expenses, okay, the cost of doing business. Now you can subtract those expenses from your revenue and we will not tax you on that. There will be no income tax on that. Okay, so those are why we call them deductions. And those deductions equals tax savings, right? Well, and at the end of our revenue and expenses, we can have profit or loss. So what the IRS is saying is that we're not going to tax you on the expenses, only on what's left over as profit. Now you also, as a business owner, can have a loss, and that loss can be written off other incomes if you have other incomes, okay, because your business is a separate tax entity. All right, so when we started looking at deductions, we found that there are two types of deductions. The first type is what we call non-appreciable deductions: office supply, office furniture, company vehicle, that sort of stuff. Okay, where non-appreciable deduction, meaning that you can get that it's an expense, yes, so therefore it's a deduction. You still get the tax savings, but whatever that dollar amount is today, it won't be worth more tomorrow, or the next day, or a year from now, or 3 or 5 years from now. Okay, so it doesn't appreciate. Okay, in fact, depending on what your expense is, you can actually have a depreciation schedule for that particular thing. So if you're buying machinery for a business, most people would consider it an asset, but the government allows you to depreciate that asset, depreciate that expense. Okay, so we can talk about that another time. So if we have non-appreciable deductions, then we have appreciable deductions also, right? So appreciable deductions, which would you rather have? A deduction that allows your money to grow and appreciate year over year and be worth more later on than it was worth today, or a non-appreciable deduction which only brings the value of the tax savings the current year? Which would you have? Everyone chooses appreciable deduction. Obviously, we understand money. Okay, so if you have that available to us, available to yourself, then why don't we take the advantage of that? This is what we do: appreciable deduction planning. This is our expertise. Okay, your current CPA and enrolled agent may only be an expert at non-appreciable deductions. We don't know. Again, we don't know you. We don't know your CPA. We are not replacing your CPA. We are actually being added to your team to help you and your CPA. Why do we say help you? On your tax form, who signs the tax form? Exactly, you do. So it doesn't matter what your CPA knows or doesn't know. The bottom line, it falls on your shoulders. So you are responsible for hiring the professional to help you. So you need to hire a team. Okay, so many times we find it's more than having an expert in non-appreciable. You need to find an expert in appreciable. Okay, so that being said, we talked about revenue and income. It goes down a certain pathway. You can have taxable revenue income or tax deductible revenue income. Okay, now I use the term revenue income because they mean different things. If you're a business owner and you're generating sales, that's revenue. After expenses, it becomes income. If you're an individual and you're earning W-2 income or 1099 income, that's income. Okay, but both can go down a pathway, and they both can go in a pathway that's tax deferred. Now the key here is the exit strategy. Does it go out which which way, taxable or tax-free. So if you had a preference, which would you prefer? Would you prefer tax-free or taxable? Everyone chooses tax-free, right? In our industry, we'll say tax advantage, okay? But the reality is as an individual, you're looking for tax advantage means tax-free, okay? Now, does that mean everything we do in our business and as experts provide that? Absolutely not. No. All we're saying is this is our goal. Exactly what we were talking about with the map. The IRS gives us a code, they give us a map, and we have to decide on what's the best route from point A to point B, okay? And that does not mean that everything is going to go down this same pathway, okay? That's where this expertise and the analysis comes into play. Okay, so let's look at an example. Let's put some dollars to this, if you don't mind. We're going to use this example moving forward in the rest of the webinar, okay? So we have adjusted gross income at $500,000. Your lifestyle income is at $300,000, okay? So that means that non-lifestyle income is $200,000. This represents what we call an opportunity cost. The opportunity cost is an economic term that says if I'm doing A, which is what we see right here, I could be doing B, but I don't know what that cost is. I don't know what that's going to be, positive or negative, okay? So what we're going to do is we're going to show you numbers of what you're doing today, A, and what B, if you chose to do B, what that could do for you, okay? So in number forms, all right, based on this example. Now there's some byproducts of this planning, okay? Now we don't focus in these areas. These three areas, tax efficient planning, wealth accumulation, and wealth diversification, we're not focused in these areas, okay? What we're focused on is putting our dollars, our $200,000, to better use, to redistributing, to shifting them into areas that make more sense based on your plan and trying to develop stuff. Now these three things are byproducts of that. So think about the last vehicle you purchased, okay? There are things on that last vehicle that you could care less about. You probably don't even know they're there. Now, if you knew they were there and you say, oh, Mr. Dealer, I don't want these things, what are they going to tell you? Well, tough. They come with the car. Same thing here. These three things come with the car. These three things come with the planning process. We're not focused on them. They're just byproducts of it, okay? So as another thank you, you have the opportunity later on, we'll show you how to do this, to where we can do a tax return analysis for you. And the tax return analysis goes through, talks about taxes. We'll look at your 1040 in your existing current situation. We'll look at your 1120, so your personal and corporate returns, and all your returns that you have. Okay, and so we'll put it here, and then we'll look at a budget. We'll look and try to figure out what that lifestyle income is, or lifestyle expenses are. And then we'll show you where the leftover comes in, okay? We have found our business owners love having this on one page. And so we've been able to create a tax return analysis to give you a one-page side-by-side scenario of what we're talking about, okay? Now, here's how we do it. We go through your 1040, we look at your W-2 with line 7, we look at your K-1. In this situation is S-Corp, is line 17. There's your AGI. Then we go to page 2 and we look at your itemized deductions, we look at total tax owed, and that's kind of the process we go. Now, page 3 typically is your Schedule A, your itemized deductions, or line 40 on the previous. So see line 40 up here on the top right here? Okay, that goes to Schedule A. See where it says Schedule A? So Schedule A is right here. Now, some of our largest itemized deductions are right here, is what we call SALT. And this is changed in 2018 with the Tax Reform Act. It's SALT stands for state and local tax. Okay, so what it's saying is that right here is this $81,000. What you used to be able to do is take your state tax that you owed. So let's say you're in California and you owed $81,000 in state taxes. You were able to put it here and deduct it from your federal return. Okay, the federal government now has capped it at 10 grand. So in this scenario, if I have $81,000 that I'm writing here and I can only do 10, what happens to the other 71,000? That's right, it now becomes taxable income, okay? And down here, line 10 is your interest, mortgage interest, so it's not even affected by SALT, okay? All right, and this explains what that is. So the other thing we're going to do is that if you engage our services and want to take the next step forward for after the tax return analysis, we're actually going to do a tax bracket analysis. We're going to go through and show you, based on the federal tax brackets, called a progressive tax system. And so what we're going to do is going to walk through this with you. And so basically how this works is that the first $19,000 of income is free of tax, 10%. Okay, anything after $19,000 is capped at 10. Between $19,000 and $77,000, you're going to pay a 12% tax bracket. So the first 19 is 10%. That's where this 1900 comes into place. If I made 77,400, so the difference between 19 and 77 at 12% would be $7,002. You add these two up, and that's your total tax owed in this bracket, which is 8907. And you continue to go. So let's go through our example of 500,000. So our 500,000, our total tax owed is 26,000, right? So our first 400,000 is taxed at 91,000, right? So here's how it works. You take the 64 from the previous bracket. If we're making 500,000, so the 315 to 400 at 32% is 27,000. You add those two up, and that's 91,000. We have 100,000 left over, so that's taxed at 35%, and you add these up, and that's where you get that. Okay? So, but in our scenario, we said we only need 300,000 to live off of. So if we only need 300,000, that means we're only paying income tax on 60,000. That's what we actually need, because this other 200,000 we're going to shift back to the corporate return as appreciable deductions. Okay, so what that means is that that's a $65,000 tax savings just federally. What could you do with an extra $65,000? Okay, again, the mind's open. This is why we focus on increasing your cash flow, where our focus is your cash flow, not your dreams, not your goals. We want to focus on cash flow. Okay, so let's look at that opportunity cost of the current planning. Let's take the scenario of the 65,000. Let's say it's over a 20-year period, so we're going to assume you're 45 today, you're going to be 65 when you quote-unquote retire, and so that's a 20-year period. And let's assume that that 65,000 is going to appreciate every year, compounding at 5%. So what that value is $175,000, right? If I were to round up. So that's a pretty significant amount of money, okay? That's what it values at. Now, most people say, Bob, we're not going to do this just 1 year, because guess what? We're paying taxes every year. That's right, you are. So in this scenario, 65,000 at 20 years at 5%, now it's actually worth $2.1 million. This is what you could be giving up to the IRS, is $2.1 million. This is current opportunity cost A. This is what you're currently doing now, right? So if you did not engage our services, you kept doing what you're doing, the status quo, here's what it's going to cost you. Okay, but remember, we weren't talking about the 65,000. We were actually talking about the capital restructure that's shifting the 200,000 off. Okay, and let's use that same 1 year scenario. We did that this year, and over the 20 years at 5%, that grew to just over $500,000. Okay, so that's a significant growth. There's some meat to that, right? But again, if we're going to show you how to do this in year one, you're going to say, Bob, can you do this every year for the next 20 years? Assuming we can, at a 5% appreciation, that grows to $6.6 million. So the question is that of that $6.6 million, you said earlier you wanted appreciable deductions. You said earlier that you wanted tax-free income. So what if we were able to, out of this $6.6 million, how much of this would you want to be tax advantaged? Right? Silly question. All of it, right? So that's essentially what we do. Okay? So our goal is to help increase your cash flow. Right? So that was what we talked about in the beginning, and we showed you the appreciable deduction planning and how we do that, okay? And we showed you the opportunity cost, we showed you dollars, what you're doing now and how we can shift that, okay? Now, as a thank you, we're going to give you a economic termites white paper. You're also going to give you an opportunity to get a tax return analysis for us free of charge. Okay. Now, one of the things I'm going to show you is that many people have asked, Bob, what's this money efficient planning? What's this? So I'm going to give you an example, if you don't mind. Use the last couple minutes to give you an example. Okay, so let's take a look. So I said earlier in the tax return analysis that we do a budget, right? So basically we want to find out what your lifestyle income or expenses are. Now we're not going to get all detailed. See, as you can see here, we don't care about all the details. We're just looking more high level what stuff looks like, right? So what we found out was, going through this is, as a business owner, you're receiving income as a business owner to pay for your personal expenses. Right? So then we looked at it and said, okay, if I were to look at personal expenses, how can I eliminate personal expenses but still not have my clients eat rice and beans and hot dogs, right? So that doesn't make any sense. So we looked at, okay, what are the highest personal expenses? Well, look at the top. It's the mortgage, right? So we looked at that and say, okay, so if we were to show clients how to pay off their mortgage quicker, and they no longer needed that $4,300, what did that equate to income-wise? So what we did is we looked at the income, and we said, okay, assuming a 24% tax bracket, most of my business owners are in the 35% tax bracket when they meet me, okay? So let's assume 24. Let's be conservative. I need $64,000 of income that's taxed at 24% tax bracket to pay for my $4,300 a month mortgage. If I didn't have this mortgage payment anymore because Bob's firm, Terra Firma, showed us how to pay this off sooner, that means that $64,000 of income we don't need. So what do? Exactly, we shift it back up the income funnel to the corporate return as an appreciable deduction. That equates to an estimated tax savings of $15,000 based on the 24% tax bracket. If you're in a 35% tax bracket, this is larger. Again, we're only talking about federal taxes here. So if you're in a state with state taxes, we have to take that in consideration as well. But we do that on an individual basis. Okay? So what's the other opportunity cost with this? Well, if we showed you how to pay off your mortgage quicker, guess what we also reduced? Your overall interest that you owed. So assuming a 30-year fixed at 4.9%, you would end up owing almost $728,000 in interest over that 30-year period. If we were to show you how to pay this off sooner, we would save you over $400,000 of interest payments. Okay, so now people go, Bob, wait, time out, but I get to write off my interest on my mortgage. You absolutely do. But look at your mortgage, look at your interest that you get to write off. Is it greater or less than the $15,000 tax savings? Many times it's less than this $15,000. So which would be better for you? This, right? So, and then we looked at student loans and credit card debt as an example of how to get those paid off as soon as we could. So that's another $1,700. So you add those two up, and you essentially have $6,000 or $72,000 a year of expenses that we free up, that we can shift. So that could be almost another $100,000 of income. So instead of $300,000, now you only need $200,000. So now we're shifting $300,000 back up the income funnel. Okay, so again, our next steps is click on the link to schedule a 30-minute session with us, and in that session we're going to show you how to get your free tax return analysis and what information we would need, and plus we're going to receive an email from us from our white paper, Economic Termites. So I took 31 minutes of your time. I hope it was well worth it. I enjoyed this. Thank you very much, and I look forward to the opportunity to working with each and every one of you. This is Robert Wolf with Terra Firma Business and Financial Consultants. Thank you so much.